Good afternoon, ladies and gentlemen. Thanks very much for joining us this afternoon to what we believe is going to be a very interesting webinar discussing the upside of scenario planning and its value to strategic risk management. Scenario planning has been around in various forms for some time. I think some of us who is maybe as old as me remember the early days of Clem Sunter and his high and low road presentations, and it got us to sort of try and look over the horizon and around the forest somewhat. And of course, he had many other publications, and with respect and credit to him for that. And of course, when we think about strategy and strategic risk management, enormous amount of publications and books are obviously out there on it. But a simple and straightforward model, as evidenced by Porter's 5 forces, also indicates that we should really be looking throughout our value chains and understanding how our entire business model works through all of the external and internal influences, and that obviously applies with enormous relevance to risk management. So in the context of that, scenario planning is something that we believe that should come into risk management in a more important, a specific and direct way. And the context of that then can't be, emphasized enough when you're looking at the degrees of change in our world. It's not only a South African situation. Obviously, the war in Ukraine has changed the world significantly, and to go down that the threats of that is important for now, because it shows how the world's economies have been exposed to both the effects of energy prices and food prices and dislocation of supply chains. And to a large degree, the world's economists have then, and treasuries have then tried to control inflation through interest rates. But unfortunately, interest rates are one mechanism to do something that tend to hurt your economy more. Yet we are being forced to accept inwards pricing through oil and other factors. So I think that it just shows you that in the context where we have to be aware of potential economic shocks, there are quite a few downstream implications that we should then consider in a more detailed sense in the context of scenario planning and strategic risk management. And that's why, in our view, being forewarned and forearmed, and therefore creating the silver linings, is very important. So just as further introduction, if I may just take a minute to pick up our key role players and who we are. Just a minute on Riskonet, if you allow me. We're a global risk management advisory business that's managed by hands-on partners in their respective territories with local subject management experts. And we provide solutions to our global teams with external partners in various specialist fields. We're present in 16 countries and operate across 5 continents. We're very, very happy to have one of our distinguished guests here, Paul de Ruyter. He's been engaged in scenario planning for a long time. He started 30 years ago at Shell Group Planning and has worked in the field ever since. He's written books about the subject, lectures to universities, and helped multinationals and governments with foresight. He's known for helping prepare Rabobank in the global financial crisis ahead of time. Although Paul is based in the Netherlands, he's been traveling to South Africa and has co-authored books about South Africa back to business in 1992. We're also very happy to have Tapo Chart van der Berg, who is up to recently in charge of the strategic risk management portfolio at Sasol. And he needs not much further introduction, but other than that, he's been driving Sasol's thought leadership in the ERM space. He's also the project lead driving their risk research on Eskom and the Transnet service delivery areas, and the impact that it has on the Sasol's ability to deliver on their strategic intent. He has more than 30 years experience in ERM and is a core member of the team that introduced ERM successfully to Sasol Chemicals and operations in the Middle East, Europe, Americas, and Southeast. He also played a key role in developing Sasol's risk appetite and risk tolerance statement and metric. As head of risk, he was responsible for ERM strategy, reporting to the top risks to the GEC, the Sasol board, and committees. So thank you very much to our distinguished guests for their time. Also to our support team, Roxanne and your hub and your team. You've done a great job so far, and we're really grateful for what we've achieved to date. My brief introduction then is just one more set of circumstances. There's, as I said, enough to think about in terms of external factors. But if one looks at the issues that may be facing South Africa, what could these areas of volatility include? And of course, we don't have prescriptions for them, but really, what are the issues around volatility, and why and how would scenario planning and digging into the areas a little bit further assist us? And of course, power generation has been a number one in all of our environments, but really, are we simply all waiting for load shedding levels to change and just use our generators in the meantime? And a lot of local solar, isn't that just the same as becoming a boiled frog and being incrementally cooked over time? What about any alternative? But one of them could be nodal power generation in the context of an industrial hub or wherever it may be. Doesn't that become a necessity? And when does the necessity become the mother of invention? And I think in this context, South Africans are sometimes too good at just marking a plan, and we avoid, when we don't get into the strategic change and alternative development of solutions early enough, because these solutions actually add value right through the process. There are countless economic models that show that alternative power models do pay their way. So why not just get onto a better economic return immediately and make yourselves, your region, your company more independent? And similarly, in the context of weakening transport infrastructure, we've heard today and yesterday that the private sector will be more involved. But what does it really mean? Because over time, there are a couple of other dependencies, or if there are issues around the transport infrastructure, let's change the debate from worrying about too little capacity to growing the capacity and then sharing those allocations in a different way. And that could also, there are many toll road, toll treatment, other mechanisms that are well proven that could be used in that environment. Similarly, political instability will come both pre and post the 24 election. And what does that mean to long-term projects? What does it mean to fiscal and other volatility? And who knows? I mean, we should look down that road and look for the hedges that are available. And obviously, there are some insurance hedges in the same space. And then continuing back to our first points about things like national and other international shocks. If you look at the global risks report and things like the Time magazine and other reports, things like economic shocks, cyber, interest rates, other issues are significant other factors to consider. And the economic environment and the strategic risk environment here, I think, need to be very much closer and integrated in the context of scenario planning. Access to capital is critical, and Paul will talk about that in terms of the fantastic strategy that Rabobank applied. But it also gets to capital, return on capital, portfolio construction, and a lot of financial instruments that can be developed both on a corporate basis as well as on a unitized and mutual basis to mitigate the impact of financial shocks. So luckily for all, that's the end of my introduction. I'm very, very happy to hand over to the team. Thank you for attending, and we're really looking forward to Paul's presentation.
Hello, everybody. My name is Paul de Ruiter. Happy to be here with you virtually. I wish I was there physically because I'm in Holland where it's 8 degrees. I just came back from 6 weeks in South Africa. I've been coming to South Africa for over 30 years now. It started with writing a book about South Africa back to business right after the referendum. And when we planned that, it was actually based on 2 scenarios, whether you vote yes or no during the referendum in 1992. And we were ready for a yes with actually writing the first book on the business opportunities in South Africa. I've been coming back ever since. I actually own some property in Stellenbosch, and I intend to come over even more often in the future. But I've been in scenario planning for over 30 years. It started with Shell Group planning at the moment where the scenarios were already done and where the scenarios were translated into strategies. And I was in the back of the room of the of the Australia meeting, of the Middle East meeting, or different of these, deciding whether or not to build a refinery in India or to invest in Sakhalin Island in 1992, 3 years after the fall of the Berlin Wall. And I call that the secret part of scenario planning. It's about how to use scenarios for option generation and early warning systems. And I've been writing ever since about that. I teach at different universities. I have a team, an international team, traveling all over the world to do projects for companies like the World Business Council for Sustainable Development, the International Energy Agency. The United Nations is a client. We work for governments on the future of war. We work for pension funds, banks, and basically everybody who wants to actually start developing competences in scenario planning. And I was asked to tell you a little bit about scenario planning, how it works, for those who don't know. An example of how Rabobank and Shell actually prepared their organizations with scenario planning to prepare for the oil crisis in '73, but also the global financial crisis 2008. And I'm going to share with you our current global scenarios. And if you have a question, just raise your hand, and then Volker will make sure that the question comes to me during the presentation. So Shell is a big multinational, has been doing scenario planning for over 40 years now, 50 years already. And for them, scenario planning is just a department that does scenarios next to other parts that do visioning, road mapping, trend analysis, change management. But I want to stress that scenarios is a means to an end. It's not an end in itself. It's a handy tool to think about what might happen in the future as contexts, which will help you to align your vision, your roadmap, and will help you also to see the trends as an early warning signal towards a certain future, and help you to actually develop options to create the flexibility to lower the potential downsides, or even actually turn downside into upside, or to actually see potential upside and be ready for that. So it's really one of the instruments next to visioning, road mapping, trend analysis. And options is real options are a very important part of it. And I always like to explain this on a very simple way. Suppose you're on a boat, and if you're on a boat, there could be different missions. You can be on a boat just to have fun, or you can be on a boat to win the game. So if your mission is to win the game, and you're on the boat to win the game, it's very handy if everybody on the boat knows what the vision is. That everybody knows that we want to go to the east and not to the west. And that vision can be across the horizon. Because if you know where you want to go, you can actually create a roadmap to get there. If you want to become energy neutral or energy independent, so where do you start first? Do you start with batteries, or do you start with power, solar generation? Or if you are a South African-based company and you want to export and internationalize, is your first step Namibia, or is your first step Europe or the United Kingdom? So if you have a vision to go somewhere, what are your first steps? That's your roadmap. But if we do strategy, something always happens. And you can have a headwind or a tailwind. And if you have a headwind, you need to be able to go about to have the tactics to actually get where you want to go. But also, if you have tailwind, you want to have options to win the race. So what's an option to win the race if you have tailwind? Well, for everyone knows it, a spinnaker is a really important option to build. So if you have a spinnaker, so this is the big large sail for those people who don't sail. That's a big large sail, and that will help you to win the race if you have tailwind. And if you don't have that, you might lose the game because you didn't plan for a upside scenario. In terms of risk management, we often think about downside scenarios. So, as a metaphor, what if you want to win the race? You want to be at the island first. That's your vision. You know, your mission is to win the race. In a scenario shock. You know, so any suggestions? You can do that on the chat. Any suggestions to win the race in a scenario shock? You can use the chat for that. Well, you know, one of the first things that you can, most people think of is a harpoon. It killed the shark. But it requires us to invest in a harpoon before we go out to sail. So we need to be able to value the investment in a harpoon vis-a-vis the potential downside of not having the harpoon during the race. And you need to invest that before you set out to sail. Another alternative is to go around it, but then you need to go, you know, do I go left or right? Another option in the chat is to ignore it. You know, if your boat is big and strong enough, if you have a full metal big ship, then you can ignore it. But what mostly happens is the following. First is people ignore that there is a shock. So we don't even see it. So there might be a risk manager say, oh, there might be a shark, and then you get ignored. And then you see the shark and you start shouting, oh, I see a shark fin. And they say, oh, it must be a dolphin. So you get ignored until the shark is there. And then people are in a panic and they say, oh, go about, go. And people say, oh, go port side. No, the other side. And you get the harpoon. And they say, oh, we didn't invest in a harpoon. And then you're in a panic. And what most organizations do when the crisis is there is they chuck people overboard. They throw people overboard. And it's mostly time, not the people that you want to lose. But the alternative, you could have thought about going about, you could have thought about a harpoon. You could even have thought about letting another boat go first. An important option is to wait. And one of the, well, this is quite important option. Because sometimes you don't want to be the first mover. For instance, if you see digital disruption in your industry, you can choose to be either first mover, or you can say, I want to be a fast follower. Let somebody else experiment with this first, and let me copy that once the others done it. And this is actually one of the options that Shell used in 1992. That was 3 years after the fall of the Berlin Wall, opening of the Soviet Union. A lot of oil fields came on the market, and their assessment said, let's bid for these oil fields. Let's make sure prices are up, but let's make sure that we don't win any one of these. And let's wait and come back 3 years later. So the option to wait, or the investment in something, you know, to mitigate that risk, can actually help you to win the race. So it's a relative game. Are we better prepared for the scenarios than others? So that's the metaphor of scenarios. The shark is basically something that you can't choose, but the option is something that you can choose. In terms of methodology, it's quite important to separate scenarios from options. So that's the methodology. It's a very old methodology. It's been practiced here in Holland for over 350 years. We had an admiral called Admiral de Ruiter. It's not related, but he actually practiced different war situations on the beach with his captains and steersmen to say, what do we do if the wind change? What would we do if the enemy attacks from this side? So he practiced different scenarios with his teams, especially the difficult scenarios, to be prepared as a team and to have the intelligence that the team would see itself that the wind is changing, and that the teams themselves would know to go about or to get the harpoons ready. So training with your team. So I think a lot of risk management is a heat map and analysis, but you should actually use scenarios as an exercise with your team to develop options, to value options, and also to train your teams to see the early warning signals. Because once you have practice for a shark, you recognize fins, because there's a difference between a fin that goes like this, a dolphin fin, or a fin that goes like this. Well, it's different from a ski. Goes straight at you. So being able to see early warning signals to say, we are now entering scenario number X, and that means that we now need to exercise a certain option. And that's the what if question. And how Shell made money using these kinds of scenarios is that, and Arie de Geus wrote about this, is that before 1973, there were scenarios about a scarcity of oil supply and therefore an increase in price. And when that happened, and they actually, did some quantifications. This is the original document of 1971. They said the tailoring agreement might end, and then we might see a tripling of oil prices in 1976. As you can see, the scenarios are wrong because it happened in 1973. It happened 3 years earlier. But practicing the scenarios with their teams helped Shell to generate options. And the two options they generated was, one, creating a real call option, so the right and not the obligation to invest in North Sea oil and gas. And because in 1971, nobody wanted to have North Sea oil and gas because it was too expensive compared to Saudi Arabian oil or the Middle Eastern oil. So they could get the option almost for nothing. The second thing they did using the scenarios was creating a real put option on all of the refineries that they ordered, because a refinery will cost you $1 billion a piece and it'll take you 4, 5, 6 years to be delivered. And in the contracts with their contractors, they put in cancellation clauses. And in 1971, nobody believed that there would be an oil crisis. Nobody thought of it. So everybody gave away cancellation clauses in their contracts for nothing. So they generated real put options, so the ability to stop something, and they generated the ability to start something, a real call option, using those scenarios. And then when they actually, with the Yom Kippur War in 1972, 73, they saw we now have the signal of a imminent oil crisis, and then they exercised their options for developing North Sea oil and gas and for canceling refinery capacity. And that saved them billions, not having to actually accept all of those refineries that were in construction, and they could invest that money into North Sea oil and gas. So basically they went from a predominantly downstream business into an upstream business. And this is how they made money in the oil crisis. So for them, it wasn't a risk, it was an opportunity because they were well prepared. So this is using real options to create upside out of a downside scenario. The same thing happened in Rabobank, and I have helped them 20 years ago. In 2000, we started building capacity of scenario planning in Rabobank. We already did a successful project in 2001 with them, and then we did bigger projects. And one of them actually helped them to prepare for the global financial crisis. And Rabobank made 2.8 billion euros in profit in 2008. And they actually reported and warned in the newspaper of February 2008 of an imminent financial crisis in Europe. And that was before Bear Stearns and before Lehman Brothers faltered. How did they do that? Well, they did it because they did scenario planning and modeling. And one of them was a inverse interest rates scenario. And when they saw interest rates going up from 1% to 5% in 2 years' time, they actually saw that because banks make their money by borrowing short and lending out long term, is if you have to pay 5% on anything and your mortgage only gets you less than 4%, banks will falter. And this was already happening 2 years before the global financial crisis. The steps were going up. And leading up to that, was higher oil prices and inflation. And that was triggered by the Iraq war. So they had a model giving them early warning signals, and then they created the option to stop borrowing, lending money to Bear Stearns. So they had 2.5 billion. They were lending 2.5 billion euros to Bear Stearns, and they actually canceled the first 500 million, and then the 2 billion later on. So actually, they exercised their right to stop lending money to banks that were about to go under, based on an underlying model of how war and sanctions, and this happened in '73 with the Yom Kippur War, it happened in Iraq, and it's happening now with the Ukraine, leading to a hike in oil and gas prices. That happened in 1973. It happened in 2005, 2006, when we had already $120 oil prices. Then, because that leads to inflation, and with a time delay, interest rates go up, and with a time delay, asset prices go down, and with a time delay, government spend go down. And we see that pattern happening again. That happened in the 70s, and it happened 15 years ago. So this is where we are today. Let me tell you, this is how scenarios are used by Rabobank and Shell to already think about what might happen, to see the possible shocks, to think about options, to be able to manage those risks and turn downside into upside. With our clients, since February, we're using the following 3 scenarios. We might end up in a synchronized downturn. In the global financial crisis in 2008, Europe and United States went down, but not China, and therefore Australia did quite well. But now we actually see, because of everything is so connected, that if Europe goes down and the United States go down, China is also on the verge of going down because they're so connected. And on top of that, the debt levels now are bigger than in 2006. So this crisis might even be bigger than the 2008 global financial crisis, the synchronized downturn. That's one scenario. Another scenario is a winner-loser scenarios, because don't forget, United States is exporting gas, they're exporting wheat, and they're exporting weapons. So they're actually a winner. So who are the winner and loser? So basically, it's not just a global financial downturn. It might be a winner-loser scenario. And the third scenario that we actually see happening is that everybody is now shifting to go green, a rapid transformation. And so basically, it's not an era of change, but a change of era that we're seeing. We're entering the post-fossil world. Let me go a little bit deeper into the 3 scenarios that we're currently using with our multinational clients. The first one is a synchronized downturn because of high inflation, which are now actually into the wages as well. So we see a wage price spiral going up, inflation not going down, therefore interest rates continuing going up, and therefore we see a serious risk of a synchronized downturn all over the world, with effects on food prices and political unrest and continued increasing war and migration streams. And migration is also a big issue, I think, in South Africa. And once you have a scenario, what we do, and we use IT and artificial intelligence for that, to pick up all of the signals around the world in the different languages. And these are just a few signals that point us into a synchronized downturn scenario. So my question to you would be, is your organization prepared for a synchronized downturn, a global financial crisis, even worse than that we had in 2008? With the war and migration and political unrest as a result of it, because a lot of East Africa does not have access to food, even if there was grain. they couldn't pay for it. Do you have a plan ready, and do you have the intelligence to see this coming? That's my question to you. Second scenario is the winner and loser scenario. Like I said, it could well be that there's an asynchronous impact of what's happening, and it could well be that Europe is hit, but already we see signals that in the Middle East they're partying. They're richer than ever. And if you're in specific sectors like the weapons industry or in the food industry, you have a boom scenario. So who are the winners? And we see losers in terms of people starving from hunger. And we see actually energy intensive companies shutting down in Europe because they can't pay for the gas bill. At the same time, if you're in the if you're Cargill or ADM, or if you are in the oil and gas business, you'll see record profits. So win and losers both sectoral and geographical. And each of you, so you need for our pension funds, they are thinking about where to shift our money. In which sectors do we want to invest, and in which regions do we want to shift our money? But then you see a self-fulfilling prophecy. If you are in a risk sector or in a risk geographical area, people are also pulling their money out, worsening the situation there, and increasing your risk profile and your credit premium. And if you're seen as in a winner sector, your access to capital increases and it gets cheaper. So it actually, it's pro-cyclical basically. So that's a winner-loser. Are you ready? Do you know who the winners and losers are? And are you betting as a company in the right sectors and in the right geographical areas? And do you have the signals to see it coming? Third scenario, rapid transformation. Basically, we see is that will, to all issues there will be an end. But especially what is important, because oil and gas is now so expensive in Europe and the United States, everybody wants to shift away from being oil and gas dependent. So next to climate change and extreme weather events and all dependency, we now have a huge financial impetus to speed up the energy transition, but also the food transition. Because also if food is expensive, if grain is expensive, we'll find alternatives for beef, because you need a lot of wheat to feed the cows to get the beef. So we see very strong transformations in those areas as well. And if you look at the signs, currently there's a trade war between Europe and the United States on who is subsidizing the energy transition fastest. There is the Inflation Reduction Act in the United States. They're spending over $177 billion. And now there's a fight with Europe, and Europe wants to invest even more than the United States. And we see and technology become available, new ways of working become available. But in the end, the long-term effect is that in 2-3 years, the demand for oil and gas, for fossil fuels, will go down because it will have been replaced by these new technologies. So a rapid transformation, and this also comes back to what Volker said in the beginning. I was in Swellendam just in December, and we didn't have load shedding. We had a blackout for 30 hours. Freezes. Our medicine was at risk. My phone was dead because the power was down. So I think that there's a huge impetus also for South Africa to be in a rapid transformation. And the fact that there's so much money available now at pension funds and governments, and there's new technologies available now, how can you gain from that? And also, how can South Africa position itself in the power play that's happening now? Because if you look at the pension money that we have in Holland, it's 1,400 billion. Where do we invest? Is South Africa a winner or a loser? Is it part of the rapid transformation? And how will they be hit in a global financial crisis if that happens? Those are questions that people in Europe are asking themselves. Where do we put our money? Where do we place our bets? But do you have a story and do you have your plans ready for these three scenarios? These are just three scenarios I want to give you as an example. So I gave you the history, the theory, two examples, and current scenarios. And the point is not to pick the right scenarios, but we cannot predict the future, but we can choose our options. So what options do we have that make sense in any case? A robust option. What options do we need to develop to start off if it happens, like the harpoon? And what is it? What are the stop options? You know, who do we want to throw overboard? But actually, really, where do we want to cut down in certain scenarios that we have our plans ready today? That was my story about scenario planning in the last 30 years and the recent insights of our scenarios and how we apply scenarios by simulating the future, generating options, and then developing a better early warning signal to actually know when to exercise our options. If there's any questions or recommendations, please ask, but this is my presentation.
Thanks very much, Paul. And I'll just stay off the screen, but just to give everyone a chance to think about a question or two. We have our own questions coming through as poll questions, and I'll just give everyone a bit of a taste of what we're looking for, and then we'll flight them through the next half an hour, 40 minutes or so. So everyone's got a good feel for what we mean by scenario planning. And then Tup will come along and give us an excellent rendition of how it's been applied in the Sasol context as well. So are we thinking about that? The kind of polls that we're interested in addressing, and please feel free to answer any of them, is really how do we make scenario planning more relevant and tractable and gain traction in this environment? So we'll ask you, for example, is scenario planning too theoretical, or can it be sufficiently practical to contribute to risk management? Now, Paul's just shown us a very straightforward way of looking at the tools and the options. Secondly, is strategic risk management includes capitalizing opportunities, then does scenario planning balance the organization's perspectives, or is it not really helpful in the context of it being too theoretical? So we won't rush them all through now, but this is the poll, and we'll give you a chance to look at these over the next few minutes once you get a sense of what we're looking for. And so similarly, we're looking for the alignment between scenario planning and risk management, and you'll see that question coming up. And then whether it's relevant only in the global context or in the local context. We think obviously that there's merit in both sides. And then how do we integrate scenario planning with strategic risk management? And lastly, can scenario planning improve our risk management agility? And I think those are all nice ways of thinking about how the real value add can come through from scenario planning. So there's your first one up. Please tick the box that you like, and then I'm sure Tup is well warmed up by now. Paul, you can stop. We'll still see if there's a question for you or not. And of course, after both presentations, we'll have 20, 30 minutes to discuss for questions or have a general conversation. So we'll hold on for a minute or two if there's anything for Paul, and you're welcome to answer the first poll, please. Paul, it looks like you've given everyone the answer. So
I hope so, that I was clear, or maybe nobody could understand me.
Okay. All right, so there we have an answer. So very good. Thank you very much for your answers. That there is a view that makes a substantial contribution. And we'll close this poll and move on to the next one as we move into Tup's presentation. But feel free to raise questions on any part of the presentations, the introduction, Paul's and Tup's at any stage. And we'll obviously take a pause when it's relevant and we'll move along from there. Raise them in the chats and we'll obviously deal with them as we see them. Thank you very much, Paul, and we'll move over to Tup now. Okay.
So if I can come in here as well, Volker, so we consider these geopolitical risks. So we acutely aware of what's, if you look at the Russian-Ukraine war, and then if you look at also the issues between China and between the USA with regard to Taiwan. So we really make sure that we keep it on the radar screen, and then where appropriate, we will then make sure that we do not invest in countries where we will be directly exposed to these type of potential wars as well, as far as reasonably possible. But I think it's really to make sure that you follow a proactive stance, really understand the external developments, and then make sure that when you look at your strategy, that it gets fully acknowledged in your strategy, especially when you make your investment decisions. So I think you can just best keep track of those changes. That's all.
So Paul, please, on the international side, but then also Steve has raised an interesting point about the cost and shortage of fertilizer. And I think coming back to Paul's opportunity matrix, with prices shooting, obviously that's an opportunity for other producers to enter the market. And fertilizer is obviously quite close to Sasol as well.
Yeah. Well,
private stuff, but I think there's a good conversation point there as well. Paul?
Well, what I like about also the comments and in the chat, the question was about transparency about strategy, and to raise the other scenario that's on the radar screen as well. If something happens between China and Taiwan, and as an example of a smaller company, I had a very small startup company. They have 30 employees, and they make AI cameras to detect whether people are moving in their beds, and they're used in hospitals. So to see if people are falling or if they need care. And the director of that company said, well, if China would do the same thing to Taiwan as was happening currently, and all of our chips are from TSMC, are from Taiwan. And the nice thing, I mean, if you're quite open about your mission, vision, and your risk with your key personnel, it was actually one saying, well, nice that you are worrying about it, CEO, but I happen to know that Samsung is also supplying the same chips that we're now getting from TSMC. So if we get them from Samsung, we've hedged our bets. So often a lot of options, if you think of them ahead of time, are actually quite easily to manage. If you do that ahead of time. If you do it in the crisis, you're too late. And I really like what Tab was saying is that normally our firm is a strategy consulting firm. So we work a lot we come from the strategy side, and then we try to include the risk people to say, okay, how does this affect, so basically for each scenario, we actually take the whole risk, the heat map, and see how in this scenario, how would it change where, the positioning of the probability and impacts of the heat map. So we come, but it's just as well, is it from strategic risk management level that you can, as a strategic risk, as a manager in risk management, you can put strategy on the map. So it's nice that you actually, and you see it in Tab's chart, you can go from strategy to risk or from risk to strategy. And I think that also very important, what Tab said, is that the risk appetite is a very important variable in there. And if you don't have a high risk appetite, you need to think about these things, even if they're low probability. Last thing I want,
Okay, sorry, Paul.
Tab, go ahead.
So I just want to come in when you look at fertilizers as well. So yes, there's opportunity as well, and but the problem with fertilizers, it's extremely capital intensive investments that you make as well. So it's going to take you a couple of years to build a plant, but also keeping in mind that this whole drive to decarbonize the global economy and for companies to decarbonize as well. I mean, if you look at fertilizers, it uses a lot of products or feedstock, feedstock that's not really that much preferred currently. So you need to look at renewable energy. And you won't just invest in plants that's going to consume a lot of fossil fuels. So you probably will focus on renewable energy, and most of those technologies are still nascent technologies. So it's not easy to make up the shortfall. That's why you see a significant increase in fertilizer prices. So I mean, both those countries are important producers.
capital intensity, if
Yeah.
looking, helping, Dutch pension funds and insurance companies with their asset management and asset allocation, I think the whole question of alignment of South Africa with Russia is a key one. So who do you align with is on the agenda. So if you look from Europe and if you shifting billions and you see Europe is risky and the United States is risky, there are areas I bought my first apartment in Blaubergstrand in 2001 because after 9/11, all of a sudden, South Africa looked safe because it wasn't in that conflict. So South Africa could position itself as a safe place in this conflict, as a place where there's lots of sun, where there's lots of wind, where there's lots of, so there is, and where there's, you're not, and there's tailwinds for South Africa. But if South Africa is seen as just as risky as the others, people will shy away. But if you have a strategy as a country saying that actually, yes, there is lots of risk out there, but we are prepared for that. We have a strategy for that, just like you had in 1992 with your scenarios, the flight of the flamingo scenarios rather than the ostrich scenarios. So if there's a good story coming from South Africa, that could definitely attract lots of capital that's looking for an alternative place than the not so safe places in Europe and the United States at the moment. So you could actually attract collectively capital, but that depends on who do you align with, because if you are seen to be aligned with Russia, the capital will definitely not flow to South Africa. So that's, I think, but if it is, then technology and capital will flow to South Africa because it's seen as a safe hedge against all of the increasing risks in the Western world and even China.
So the problem for me is South Africa is a member of the BRICS countries, okay? And most recently, they had also a exercise where the navies were joining up with Russia and with China as well. So it's not well liked by the Western world. So that's increasing the risk from a national perspective, and we need to take note of that as well. Because we do not know to what extent the Western world will respond to this type of behavior.
And of course, there's the capital. Capital could also be available from the East. So there's a negative and a positive, and we need to see how aligned both sides become. But that awareness is key. So I'll give you guys maybe 5 minutes to take a break or perhaps listen to me. I found that there were some really nice nuggets and that came through both of your presentations that probably will feed into future articles and opinion pieces from us, as well as responding to the polls that we are showing. So please continue to answer the polls. And then the kind of thought that I had and really appreciated starting with polls is that the point about training with the teams in respect to scenario planning and strategic risk management. So, we often talk about the dynamics of risk management. So risk management is not a transaction. It's not a snapshot. It's about the video. It's about understanding the full value chain. It's about seeing, as Tapa's also said, look from the front to the back of the organization. And so when one trains and when workshops and plays through the scenarios in full, a lot of very good insights come from multifaceted teams who don't have to be risk experts, but they know their own domains well. And when they're part of this environment, they've really contributed valuably in this space. So training with the teams and making this kind of environment fun and key to the strategic process, I felt was a great point that Paul made. The other part, and we talked briefly about black swans, and I think scenario planning really further minimizes what we perceive to be black swans. And then Tup, you mentioned the word signals. That's a very nice way of indicating, what are we really looking for? Because we don't have to be perfectly accurate about what we're trying to achieve, either in strategic risk scenarios or scenario plannings. What do the signals do? What are they? How do we harvest them? Where do they align? And so forth. So I felt that was a very good directional point that we can pick up. Again, going back to Paul, you talked about the 3 areas. the synchronization of risk and scenarios, the win-lose, and the rapid transformation. In each of those, the linkage to risk is incredible because synchronization talks to systemic risk. And very often, systemic risk is not sufficiently analyzed at a strategic level because we're only looking at the company and saying, oh, well, the economy may go up and down. But there are many other systemic risk factors that we should be thinking about. Similarly, under the win and lose, great insight, because there's another strategic concept called adjacency. And so who do we want to keep as our friends? You mentioned BRICS, TUP, and who are we concerned about as our enemies? And we'd rather be forewarned to be forearmed, etc. So adjacency concepts in terms of win and lose are very, very important. And so that element of taking advantage of both the win and the upsides and minimizing the downsides for the losers and those adjacencies, I thought were very important. The rapid transformation element speaks directly to what we call risk velocity. And there are two parts of risk velocity. One is how severe and also how exposed are we. So risk might arrive in the next 5 seconds, but it's a little pinprick. It's not a bazooka. So the speed of risk also has to be calibrated against the impact of risk. Now, if we look at that kind of concept with one idea called climate change and transition risk, TUP was talking about fertilizers. Now, imagine if there was a new technology that produced fertilizer in another way and solved both the carbon footprint and the capital footprint and something else. Where would that? So you've got climate change, transition risks are talking a lot about what we call stranded assets. And so the climate risk register is becoming a big part of what we're doing now and should go into scenario planning and strategic risk management. Then moving back into TUP's area, really good linkages between scenario planning, the signposts, and the linkage to strategy, and that pathways then develop scenarios. So I thought that was very helpful in terms of how you take a theoretical concept and show how practically you can bring it into your business. And lastly, in terms of the integration of risk identification, tolerance, and profiles, and your headwinds and tailwinds, I think another part that we can really get value out of is the scenario planning shows us what to do over time. We tend to, again, I get back to the snapshot versus the video. We don't put the time context too well into our risk analysis. And if we bring those time elements in, as you showed us with the initial tailwinds and then the subsequent headwinds, you start realizing, hey, we need to prepare. We've got a year or two to prepare. What can we do about that? So I felt those were very valuable points that both of you made. I don't know if you guys want to comment further on those kinds of issues, but I thank you for that. And then just as a final context and conclusion, and we'll also wrap it up with our team, we'll get a poll question about who would you like to contact Riskonet about strategic planning and risk management and scenario planning. And that poll will come up at the end of the presentation. You're welcome to answer it at your freedom, and we'll just leave it up as the last poll. But yeah, back to Paul and to TUP. Those are my nuggets of this. I'm sure there are many more that you may want to comment yourselves.
Yeah, I just want to get to the fertilizer. So important building block for fertilizer is ammonia. So you can produce green hydrogen and produce green ammonia. So that will be then a green product that you can produce as well. But obviously the technology is still a nascent technology. It will be extremely expensive to be able to produce green ammonia. But you can also use it for other applications as well. So that's quite important to keep that in mind as well.
Oh, I like these conversations, stuff, is because if you look at what Oman is doing, Oman is making lots of money nowadays. They have lots of wind, they have lots of solar, and also working with the shipping industry. The shipping industry also needs to convert from what they're currently using to, and ammonia is one of the options because it has a very high energy density. And the factories are already being built in Oman to convert all of their wind and solar power into ammonia as a fuel, as a storage of that fuel, because it's so much, the energy density is so much better than hydrogen. And those investments are happening now. The technology is there, and we in Europe have a different problem. Our problem is where to put our money. We have billions and billions in government bonds with a zero coupon, with a huge risk. And they want to shift that money. They want to shift away from Shell. The Dutch pension funds have to shift away from fossil companies. They need to invest somewhere. They are thinking about making country risk allocations. And therefore, having stories and being prepared for all of the huge opportunity, especially the rapid transformation is giving, can both solve the current problems in South Africa, that Volker started off in his presentation. Are we waiting for load shedding to end miraculously? Or are we going to do something about this? Because the technology is there, and also the capital is there. If you align the adjacencies, if you align with where the money is, and it's seeking a place. So we need very good business cases from you guys, explaining that South Africa is not risky, but there's lots of opportunities there, and hopefully it becomes a self-fulfilling prophecy. Like my colleague Adam Kahane in 1992 did the Montfleur scenarios. And those scenarios were the ostrich and the lame duck, or the Icarus scenarios. But it also had a story called the Flight of the Flamingos. And the Flight of the Flamingo actually is what happened after 1992 for many years. And I think developing scenarios is not only a way to manage your risks, it's also to create new insights and pathway into the future that you can turn into a collective vision and roadmap and make self-fulfilling. And I think South Africa urgently needs a story of hope. And because developing a heat map with risk is easy. I mean, many risks that I can list for South Africa. But can you actually create stories of hope? Because that's what the world needs.
So I think there's a couple of mega projects going on, and they're not projects yet, they're still studies, especially if you look at Boegoebaai. So the whole idea is really to look at renewable energy to produce green hydrogen, and then ultimately, how do you transport the green hydrogen? So there's no technology available to safely transport hydrogen in bulk. So you have to then convert it into, for example, green ammonia. So that requires additional investments. So yes, there's huge opportunities, and I think load shedding is a bit of an issue, but if you then look at renewable energy, so you probably will have to look at establishing a new grid. So, and that's why most of these investments are really focusing or are targeting the West Coast, Northern Cape and the Western Cape. So that makes sense to do that as well. But you're right. I mean, it's how do you sell that story? There's a lot of green funding available. It's how do you develop a sound business case that everybody will buy into, and then get to deliver on that as well. But unfortunately, a lot of these technologies are still nascent technologies. And Sasol is also in this favorable position where if you look at our Fischer-Tropsch technology, we produce about 2 million tons of gray hydrogen. So if we can then look at adjacent technologies and then use renewable energy together with that, we can produce sustainable aviation fuel. So that's one of the projects as well. And we also talking to Germany and to some of the European governments. So there is a huge focus on that, and we created a company called EcoFT. So the whole purpose of that company is really to focus on renewable products, green products. So it's still early days. So
but the interesting thing about this is that if you look at the big risks for the airline industry, we work a lot with the airlines, but also with the airports. If you look at the airlines and the airports, they have the risk to lose their license to operate.
Absolutely.
That's a really huge risk, a license to operate. And compared to that, investing in SAF, in sustainable aircraft fuels, because changing airplanes takes decades. Changing the fuels of the aircraft is quicker. And we
Yeah.
have been working with KLM for more than 10 years now on SAF. And they have Sky Energy. And so yes, it takes a long time, but luckily people have been working on this also for decades. And we are about to see tipping points where all of a sudden we can scale up those initiatives, because there is, and that's the felicity I think that Volker talked about. So it's all about how quickly, where are we now in this exponential curve?
Yep.
In this, for instance, with sustainable aircraft fuels, can South Africa be a place where we experiment, where we do the innovation, where we have launching customers? And this is where adjacency, where do you align? Do you align with which, you know, with the Emirates, or align with South African Airways, so who do you align with? And who do you partner with? I think those are strategic questions that are risky, and therefore they have a return, because without risk, there's no return. So we want to take risk, but we want to take the risk that have a return, and make wise decisions, because we really need some wise decisions in the coming months.
Yeah.
So just to add,
I just want to add one last point.
Yeah, Karen.
Just want to add one last point. So Sasol was one of the first companies to produce
SAF?
Sorry, I can't talk. Can you hear me?
Yes, we can hear you.
Okay, so we were one of the first companies to approach Germany to look at sustainable aviation fuel as well. So, and there's a lot of, if you look at our Eco FT business, the whole strategy is also geared around sustainable aviation fuel as well. So there's a lot of opportunities, and it's actually something that you can deliver on fairly quickly over the maybe 10 to 15 years.
So I wanted to come back to that and again look at from a scenario planning point of view, how you change a big risk, which is a stranded asset, into an opportunity for new asset classes. And Tup, you just mentioned we're all looking at the West Coast and so forth. And I think that's exactly how a scenario planning can, in a sense, unhook us from too much traditional thinking. So if we're all piling into the West Coast or the Kalahari for solar power, and there's no grid there to support it, we're at risk of the herd effect, all chasing each other around to the same solution. When in fact, the actual need for power is at the industrial site. So in South Africa's context, that's at Roslyn or at Vanderbijlpark or wherever it may be, okay? And what about moving the power to the industrial site? So what about containerized nuclear or mini gas turbines or whatever? Because we're paying for the money anyway for the gas turbines, but we're told that they don't work or we can't afford them. If you actually put a funding model up for either of these, whatever they were, to the corporates who've got billions at stakes in those industrial hubs, and they could run their businesses at 100% instead of 80%, the returns would be enormous. But who's going to have the guts? And I'm glad that Dutch pension fund wants to pay. Can you imagine if we said to them, put on 10 billion and we'll move power directly to the industrial suburb? The grid is already there. You just connect to the local substation. And these are the kind of things that I think we just move the cheese. Why are we trying to create complex solutions when in fact just feeding the power directly has an alternative? And there are many other ways of creating collaborative power solutions or water or otherwise that I think new capital and new asset classes can be created to store energy where it's needed. What do you think about that?
Yeah, if you look at the renewable energy, Volker, it's really energy intensive, okay? So you require huge power plants to be able to produce electricity. So if you just look at Boegoebaai and the amount of electricity they need, and you can look at the current capacity of Eskom, you need to increase it by 2/3. So it's extremely energy intensive. So, and the thing is, you still need to establish transmission lines, and build the grid to distribute the power as well. So it takes enormous amount of investments.
Yeah, but if that's one answer, what I'm saying is there's currently a need for reliable power at our current industrial sites, not at the coast.
Yeah. So I think the option is to look at how we can produce power and then sell it back into the grid.
Yes.
So, I mean, in Sasol's case, we produce about, I think it's 30% of our own power.
Mm.
So, so that's important as well. So maybe one should look at increasing that, and you know, that capacity and maybe export. But what about roof solar top unit?
Yes.
I mean,
Well, of course,
that's
there's
also
many,
working. You can get that quickly into the grid.
And the thing is that if you look at an investment in a lot of the distribution centers, a lot of factories have huge roofs, and if you look at how fast the prices for solar panels are going down historically, but if you offset it to the current Eskom price, then you say, oh, you know, Eskom price is cheaper. But if you say, well, but if I calculate the price of not being able to power my refrigerators if I'm in retail, or if I not, you know, if my factory is not working, or people don't even go to my office anymore because, you know, there's no aircon or there's no whatever, then all of a sudden the value of having an alternative to Eskom becomes higher. So the option value in having that is increasing. So it's also about how to calculate the cost of risk and the value of redundancy and the value of your investment as a hedge against the risk. And that is what we call real option pricing. And I see that a lot of internal bookkeepers, you know, I just call them that, you know, the controllers, they can do a discounted cash flow, but they can't calculate the real option value of, you know, the option value of a harpoon, because the discounted cash flow of a harpoon is zero, but the optional value of a harpoon to shoot a shark is huge, especially if the alternative is to die. So if you cannot operate because you don't have electricity, then all of a sudden the option value becomes very high. And then also investing in microgrids, so connecting your factory to a building next to you, or taking into account that, you know, the amount of cars coming on stream with a vehicle to grid battery capacity. So integrating, you know, cars that are on your car park waiting, you know, they can be charged at the daytime, and then you can use at home to power your home. So basically charging and those cars getting cheaper by the day. And electric cars are, the tipping points are there, is that they become cheaper than a internal combustion engine car. So therefore you already get so we get enormous amounts of power storage free, because that's the option that's built in, you know, and the software is already there, the technology is already there. So if we have a strategy to see the option value of increasing power generation locally, storing it in the cars that are in our car park doing nothing, and then bringing that electricity at night where it can be used for your dishwasher, for your cooling, and so basically you bring it from the office to your house in your car. And the battery, you don't need to invest in the battery because the vehicle to grid technology is already given to you when you buy a new car.
Yeah.
But then you need to understand the roadmaps as well.
If it was left to us, we'd still be talking in 3 hours' time.
Oh, okay. Sorry about that.
I see we don't have any hands or chats, but we still have a lot of participants. So thank you very, very much for everyone having patience with our enthusiasm. As we can see there, there's a few points about the cars and so forth, but there's always practical implementations. But if I may wrap, and then maybe a concluding comment from both Paul and Chad. I think coming back to option pricing, thanks, Paul, is for me a classic, because at the end of the day, if you have to measure what you seek to manage, and that's at the end of the day. What scenario planning gives you is a whole range of potential assumptions, futures, and that, but you're trying to bring them back to a measurable and plannable and capital allocatable future. Mm-hmm. And in order to allocate capital and resources in the future, you need to know scenarios and you need to know risk. And so that kind of measurable future and getting those to me are, it really is a nice way to bring it back together. And that's what organizations and communities want, is to be able to sustain their capital and grow their capital over time. So any concluding comments on that? And then I'll wrap up and remind everybody, we'll put up contact Riskonet at the end. Welcome to say yes or no. But great thanks again. So wonderful afternoon with Paul and Tup, and closing comments from each of you. Paul?
Well, the most important thing is, again, is to practice scenarios. A lot of risk management is basically a heat map in a document, rather than a meeting where you are surprised in the meeting and not in the market. So you want to be surprised by, for instance, a war with Taiwan and the impact on your chips in a meeting, not in the market. And you want to exercise that to already see the value of having Samsung as a supplier, to see the options. And then, the controllers can actually do the calculation using the dual option theory. But the most important thing is allocate some time to think ahead. I really like your forewarned and forearmed metaphor, Volker. And to generate those options before you need it, because then you can exercise this when you need it. So that's my closing remark. Thank you thank you everybody for listening, and I hope to see you in your country very soon.
Yeah, for me, it's a change of mindset as well. When you look at your strategy and when you look at the future as well, is to really think about scenarios and really understand the risk associated with those scenarios as well, and also understand your risk profile when you look at your specific scenarios at a point in time, so that you can continuously test the robustness of your strategy. Obviously, scenarios are what they are, so it's just to be thinking differently, be more creative and innovative. That's it.
Excellent, gentlemen, and fantastic thank you to your hub team, ably led by Roxanne, Gillian, and all of our wonderful colleagues in your hub. We couldn't do this without you, and it's been a fantastic session. So thank you, and also to Paul and to Tup. Really grateful for all your inputs and insights. So we'll let the poll stay up for a little while. We will get back to you about sharing the presentations. I don't think there's anything sensitive about them, but we'll just confirm. There've been a few requests, so you're welcome. And we're looking forward to seeing lots of our community and our risk professionals in future. All the best, stay safe, and we look forward to the future, and all the best for 2023.
Thank you.
Thank you. Bye, everybody. Hope to see you in
Bye,
real
bye,
life.
everybody.